Good morning. Welcome to Market Monday for September 23rd, 2024. At long last, as we've been talking about for months, Fed Chair Jerome Powell cut rates by 0.5%, marking the end of a streak of 420 calendar days without a Fed move. This is one of the longest streaks ever without a move, but what was the longest? 2,556 days from December 16th, 2008, a cut, to December 16th, 2015, a hike. Last week, we were talking about what the market has done years after starting a cutting cycle, with either a 0.25% cut versus a 0.5% cut. And it showed that both recent cycles, starting with a 0.5% cut, like we just got, the S&P 500 stock market was still down 4 years later. Of course, these were the extraordinary bear markets of the dot-com crash and global financial crisis. Here's another look at that same information. Here's the S&P 500 stock market after the first two cutting cycles, starting with 0.5% here, and of course the market starting with 0.25% cuts up here. Well, we got 0.5%. Nothing we can do about it. With a sample size of only 5, we wouldn't put too much faith in this frame, especially with an economy that's still chugging along. Most recently at 2.9%, according to the Atlanta Fed's real-time GDP estimate. But GDP is looking in the past, no? Past economic growth is great and all, but don't we want to know about the future? And even more, if we should be expecting a market crash like we saw the other two times the Fed started with a 0.5% cut? Let's have a look at drawdowns in the S&P 500 stock market surrounding Fed rate cuts. We have 17 cutting cycles here, starting from the earliest in 1954 through 2019. Here, cutting cycles are classified as fast if there are 5 or more 0.25% cuts or 1.25% total cuts in 1 year. Slow has less than 5 cuts in a year. And in green, are one and done cutting cycles. It appears on average, fast cutting cycles tend to feature drawdowns that are double slow cycles 6 months out, and triple the drawdown of slow cycles looking 12 months out. Interestingly, non-cycles, the one and dones, were in the middle, and the slow cutting cycles had the mildest drawdowns. It seems that over the past 25 years, we've seen fast cutting cycles, which seem to be a response by the Fed to bolster a weakening economy. Let's also remind ourselves there will be drawdowns ahead. We've got it all. 2, 3, 4, 5, 6, 7, 15, 18, 19% in just the next 6 months. A little higher, a little wider when we go out 12 months. Of course, dot-com, global financial crisis, and COVID down here. Now, you might ask yourself, we've got a strong economy, the stock market is near an all-time high, so why is the Fed cutting rates? Folks, it's nothing new. In fact, the Fed has cut rates with stocks near all-time highs 20 times. A year later, how many times was the S&P 500 higher? Any guesses? All 20. Folks, as they say, if you torture the data enough, you can get it to tell you anything. Let's all take a deep breath and keep an eye on things as they come. Have a great week.